I've been looking at a ton of Indian small caps lately, right? But there is one stock in particular where I am seeing a potentially very interesting combination of business transformation, direct-to-consumer expansion, and just incredible earnings growth. Welcome to this explainer on Renaissance Global, which you might know by its NSE ticker RGL. Now, this is not just a story about buying a traditional jewelry manufacturer. My thesis here is that Renaissance Global is attempting to completely transform itself into a massive global branded jewelry and D2C platform. And recently, well, the numbers have started to make that thesis considerably more interesting. Okay, let's dive into this. For the first quarter of fiscal year 2027, Renaissance Global delivered this absolutely staggering number. Their profit after tax, or PAT, jumped nearly 289% year over year to 25.6 crore rupees. I mean, that is huge. At the same time, their revenue, if you exclude bullion, grew by 30%, and EBITDA increased by roughly 22%. Those are exactly the kinds of explosive growth numbers that just force you to stop what you're doing and pay attention.
But a single quarter is really just a snapshot in time. So the central tension, the really important question we need to answer today is this. Is RGL actually becoming a fundamentally better, structurally more profitable business? Or is this just one exceptionally good quarter driven by temporary tailwinds? Well, to figure that out, we have to break down the long-term thesis behind this company's entire transformation.
Just a quick heads up before we get too far into the weeds. This explainer is strictly for educational and informational purposes. It is not investment, financial, tax, or legal advice. I'm presenting a high-conviction, bull case investment thesis based entirely on the source material, not a recommendation to buy or sell RGA. Remember, Renaissance Global is a small-cap stock, so it inherently carries substantially higher business, liquidity, and valuation risks compared to your standard diversified large caps. Past performance doesn't guarantee future returns, and any forward-looking numbers we discuss are management's targets, not guaranteed forecasts. As always, you've got to do your own research.
Okay, here's our roadmap for this explainer. We're going to cover what RGL actually does, the big investment thesis, this Q1 FY27 financial numbers, the owned brand's margin story, the Jean Dousset retail expansion, and finally, their ultimate D2C target.
Let's start with part one. What exactly does RGL do?
When a lot of investors run their stock screens and see RGL, they just read Diamond Jewelry Company and literally stop right there. I think that is way too simplistic. For 2 decades, sure, they were essentially the invisible factory behind other people's brands, churning out products for massive mall chains. But the reality today is quite different. It's a rapid transition toward a highly integrated consumer platform model. They're basically taking this massive production engine they've built and aiming it directly at licensed entertainment franchises and direct-to-consumer labels.
Just look at the heavy-hitting portfolio of intellectual property and owned brands they are leveraging right now. You've got proprietary brands like the US-focused Jean Dousset and With Clarity, sitting right alongside these massive licensing agreements with Disney, Marvel, Star Wars, and Hallmark. They're literally turning global fandoms and luxury appeal into fine jewelry collections that can naturally command premium pricing. And honestly, that distinction, moving from being a faceless manufacturer to an IP-led brand portfolio, is absolutely crucial to understanding this company.
Moving right along to part 2, the big investment thesis.
So the crucial point is, why does this shift in their business model make the stock so intriguing right now? It's because RGL is actively, deliberately moving step by step up the value chain. They're evolving from being just a pure manufacturer to a branded jewelry provider to a direct-to-consumer seller, and ultimately their goal is to be a global luxury platform. Pure manufacturing, that's a highly competitive, lower margin game. But if you own the brand, if you control the distribution, and if you hold that direct relationship with the customer, well, you get to capture a significantly larger piece of the economic pie.
Let's hit part 3, the Q1 FY27 financial numbers. A thesis is just a nice story until the actual numbers back it up, right? So let's break down these quarterly figures for the period ending June 30, 2026. Honestly, these look a lot more like tech company growth numbers than a traditional jewelry maker. Revenue, excluding bullion, came in at 689.8 crore. That's up 30.1% year over year. EBITDA hit 49.7 crore, up nearly 22%. And the bottom line surged to 25.6 crore, which is that massive 288.5% jump we were talking about earlier. Now, what's really interesting about this slide is that the most exciting takeaway isn't actually that 288% profit growth. It's the story happening beneath those headlines. Their owned brands segment saw revenue increase by nearly 29% year over year, hitting 88.5 crore rupees. What this means is that they are successfully proving that their owned brands can grow aggressively while simultaneously improving the overall profitability of the entire business.
That brings us perfectly to Part 4, the owned brand's margin story.
Let's really zoom in on that specific margin story for a second, because this is where the real magic of a business transformation happens. In the first quarter of FY27, management noted that the own brand EBITDA margin increased from 10.0% to 11.5%. That is a solid jump of 150 basis points. So while the own brand's revenue was growing by 29%, the actual profits generated by those brands were growing even faster. It's not just, hey, revenue is growing. It is, revenue is growing and our margins are expanding.
In finance, we call this operating leverage. It's basically the holy grail for a scaling business. It happens when a company's revenue scales up much faster than its operating costs, meaning every single additional rupee of sales drops far more heavily straight to the bottom line profit. By transitioning away from that traditional low-margin B2B manufacturing and directly capturing the premium pricing of their owned brands, RGL is unlocking a very powerful economic engine.
Section 5. The Dousset retail expansion.
To see exactly how this operating leverage is being built on the ground, let's look at Dousset. This is a US-focused luxury lab-grown diamond bridal brand wholly owned by RGL. And management isn't just selling these online, they are aggressively expanding their physical retail footprint in the United States. They plan to add 4 more stores during FY27, which brings the total up to 7. But the most staggering part here? The unit economics. They are actively targeting a payback period of less than 1 year per store. Let me tell you, that is incredibly fast profitability for a physical retail location.
And this brilliantly illustrates why direct-to-consumer is so highly coveted in the first place. It is a life cycle that compounds over time. You build up the brand, which naturally lowers your cost of customer acquisition. Then you drive repeat purchases, which, by the way, RGL noted were at 17% in a recent quarter. You guide those returning customers to higher margin products, and ultimately, you transform what used to be a one-off wholesale buyer into a lifelong asset with a massive customer lifetime value. You essentially own the whole chain, from the design sketch all the way to the customer's doorstep.
Finally, Section 6, the ultimate D2C target. Let's zoom out from the current quarter for a minute and look at their macro ambition, because this is the number that makes the whole story so exciting. Management has explicitly stated a long-term goal to reach a staggering 1,000 crore rupees in D2C revenue by FY29. They plan to pull this off by aggressively scaling owned brands like Dousset, heavily investing in their digital capabilities, and making strategic, selective acquisitions.
But here is the kicker. They aren't just chasing empty scale for the sake of a big revenue number. Management is targeting at least a 15% and potentially up to a 20% operating margin on that massive slice of D2C revenue. They're aiming to radically shift the profitability profile of the entire company by ensuring this fast-growing segment is also by far their most lucrative. Let's just pause and think about what this actually means. If Renaissance Global can achieve 1,000 crore D2C revenue run rate, operating at a 15% or greater margin by FY29, well, this will no longer be a conventional B2B jewelry manufacturer, not even close. It will have completed a total metamorphosis into a global, brand-led, high-margin consumer platform. Add in the fact that balance sheet repair is already underway, debt is being reduced, and working capital is improving, it's a potent combination.
But of course, as we mentioned, these are management targets. They are not guaranteed forecasts. The pivot is highly ambitious, and frankly, execution in global retail is never without risk. But those Q1 numbers we looked at, they prove the engine is absolutely starting to fire on all cylinders. So the final thought I'll leave you with today is this. Can Renaissance Global maintain this kind of momentum, flawlessly execute this massive pivot, and actually achieve its 1,000 crore direct-to-consumer destiny? It is certainly a transformation story worth keeping a very close eye on. Thanks for joining me on this explainer, and as always, keep learning.